E12.10. On January 1st, Chevron Enterprises had 95 no-par ordinary shares issued and outstanding. The shares have a stated value of €5 per share. During the year, the following occurred. Instructions. Prepare the entries to record these transactions. Okay, so here, the shares are no par, but they have a stated value of €5 per share, right? Every time you see this, that means that we can actually treat this value as if it was the par value. So even though they are no par, we're still going to use that €5 value. Okay, so let's journalize the transactions. On April 1st, issued 25,000 additional ordinary shares for 17 per share. Well, every time you issue shares, you're gonna get money because it's basically like you're selling the shares to other people, right? So your cash has to go up. Now, remember that I told you that every time we're dealing with ordinary shares, we're gonna have share capital ordinary, and that is going to be the number of shares times the original value that you paid, right? If it is different from the issuance value, then we're gonna have share capital ordinary and share premium ordinary, right, to cover for the difference. So over here, we are going to have share capital ordinary, and that is going to be our 25,000 times our original value of 5, which give us 125,000. And our cash is the issuance price, so it's how much we got for issuing those shares. So it's going to be the 25,000 times the 17. That gives us 425,000. And the share premium ordinary is going to be the difference between these two numbers. In our case, that is 300,000. The next one happened on June 15. Declared a cash dividend of €1 per share to shareholders of record on June 30. So every time you see this keyword over here, declare a cash dividend, that means that you have to calculate the number of shares outstanding. And for you to do that, there is actually a formula. I'm going to copy and paste this here for you. This is the formula that we're going to be using. So the number of shares outstanding is going to be equal to the original number of shares that we had plus all of the share issuances, and less the treasury shares issued or purchased, and plus the treasury shares sold. Okay, so in our case, I'm just going to call this shares outstanding SO. Okay, so the original number of shares that we had was 95,000, and up to that point we just have one issuance of 25 extra shares. So that is going to be 95,000 plus the 25,000. So currently the number of shares outstanding for us, it is 120,000. From that number of shares outstanding, now you can go ahead and multiply by the value that they gave you. In this case, it was €1 per share. So that is just going to be 120,000. Okay, so that is going to be the value. Since this is the declaration of a cash dividend, we cannot credit or debit cash, right? Because this is not the payment, this is just a declaration, which means that what we are actually going to debit is cash dividends, because like it was stated, it is a cash dividend, so cash dividends go up. And since I have these dividends that I have to pay in the future, I have to credit dividends payable, right? Dividends payable, you can see over here, it is a payable, which means that it is a liability, and all liabilities, they have a minus and a plus. So over here, it is on the plus position, which means that our dividends payable are going up, and the value, it's going to be that 120,000 euros that we just calculated. The next one happened on July 10. paid that €1 cash dividend. Okay, now we actually paid it, so that means that indeed our cash can go down. And previously we said that these dividends payable are going up, right? Now we have to reduce them because we pay them. So dividends payable is debited in order to reduce it. And the value is going to be the same value that we declared before. Next one happened on December 1st. Let's see what it says. Issue 2,000 additional ordinary shares for 19 per share. Okay, so at this point I believe you should be familiar with the procedures, but since you issue shares, your cash has to go up. And then here we're gonna have share capital ordinary and a share premium ordinary, right? Because there's going to be a difference. The cash is going to be whatever number of shares that was issued times the selling price. So in this case, it is 2,000 times 19. That gives us 38,000. And our share capital ordinary, it's going to be the 2,000 times the original value of 5, which gives us 10,000, and the difference is going to be 28,000 for the share premium ordinary. Okay. Next happened on December 15. Declared a cash dividend here again, right? It is a cash dividend. So before we actually see the rest of the sentence, what do we have to do? We have to calculate the number of shares outstanding, right? Since the formula is the same, I mean, in theory, you could just add the other issuance. So, I mean, from here to here, we just had additional 2,000 shares that were issued, right? But if you wanted to do the whole thing, you can just repeat the original number of 95,000, and then 25,000 were issued, and then 2,000 extra were issued, which means that now we have an outstanding number of shares of 122,000. And now we can go ahead and multiply this number of outstanding shares by the value that they gave us. In this case was €1.20. And that will give us, that gives us 146,400. Okay, so here they're asking us to journalize this declaration of cash dividend, right? Okay, so like I said, this is not a payment, so no cash by itself is debiting or crediting it. We have cash dividends, this account, that is going to be debited because it's going up, and the dividends payable are also going up, and both by that amount that we just found of 146,400. That is the last entry that we have to make. What if they said, okay, we paid that dividend? What would you do? Well, you would have this entry, right? This is the paid dividend entry. So you would have dividends payable of 146,400 and cash from the same value. Okay, let's see letter B. How are dividends and dividends payable reported in the financial statements prepared at December 31st? For this one, we have dividends and dividends payable. Let me show you this image here. So this is something that you learn on chapter 1 from accounting, right? Dividends are over here. They belong to the retained earnings part, which means that our dividends would be presented in the retained earnings statement, okay? We have a retained earnings statement in which they write all of the revenues, the expenses, and the dividends that we have. So the first part, they're asking for the dividends. They would be presented under the retained earnings statement. Then they ask for dividends payable. Dividends payable, every time you see something payable, that means that you're talking about a liability. So dividends payable are under liabilities. And the statement that has assets, liabilities, and owner's equity is called statement of financial position. So our dividends payable would be presented under the statement of financial position.